Hello, everybody. So yesterday was a very good day with the stock of Opendoor. And Opendoor is one of my contrarian positions, one of the positions where I would think most people disagree with me, but that's okay. It was up 33%, and actually, if you look over 2 days and also go after hours, it was up 41% in 2 days. So just like the market turned against Opendoor extremely quickly and made the stock drop 90+% very quickly, is it turning again for Opendoor? Because this stock has been left for dead by the market in 9 months, and it seems like at least yesterday there was a rediscovery of the stock. We haven't had a bounce like this in a very, very, very long time, if ever, for Opendoor. And this is because great things are happening internally at Opendoor. Like I said in my prior video on the stock, 92% of a loss-leading Q2 cohort has been sold or is under contract. And of course, Q2 didn't work. Why? Because the Fed hiked interest rate 21-fold. Right? That's also why the banks are failing. Almost nobody predicted that, right? The Fed had said we're not raising rates until 2024, and so they got caught in this macro storm. That's the main reason. That's what happened. You got caught in the macro storm. But the new homes sold today, the new cohort bought after Q2, after they changed their algorithm, is profitable. It has an 8.5%, a plus 8.5% contribution margin versus about minus 7% on the old cohort. And Kerry Wheeler, the new CEO, is engaging in a cost-saving spree. They've laid off another 500 plus employees, so they've laid off almost half the firm at this point. This is the second round of layoff, right? They're making lowball offers right now, to a point that only 15% of sellers accept, and only 15% who ask Opendoor for an offer accept that offer. That's how low these offers are. So they're extremely picky in what they buy. Right? They're moving beyond doing simply repairs and simply being a marketplace, but now are acting opportunistically with opportunistic renovations. Right? They're also being opportunistic in their buyback of debt. They bought back some debt at an $88 million discount because the market is, counting them as dead, and thus their bonds are trading at crazy low valuation. They're also partnering with former competitors to get offers in front of eyeballs, to get more offers in front of people. And, there's a few things in there that I dislike. I will say, lowball offers is not how you build a long-term business. It's not. Long-term business is you gotta offer a fair price. Opportunistic renovations, you gotta be careful. You don't want to end up being a home flipper. You're going after changing the marketplace. That's my view of this stock. But right now, this stock is doing this because the market is begging this stock to do this. And it's not like Opendoor, can ignore the market. Opendoor is not Tesla. It's not a $500 billion market cap company who can do whatever it wants. Opendoor has pressure from the market, and they've caved to that pressure. That's why they do a few things here, which I think are more short term. And I do miss the visionary founder of Eric Wu, who was very, very long term and had a clear vision of being the main marketplace, being the online marketplace for buying homes, entirely disrupting the traditional real estate sector, entire and complete disruption. That's the vision I invested in, and I think it will come back. But right now the new leadership is a full of finance folks and finance people. Kerry Wheeler was a former CFO. She was promoted by CEO as a CEO, and of course that's what you do. You focus on the cash burn. You focus on the short run. And you're very, very, very careful. But I think they're going to be in for a positive surprise coming up, because this assumption that rates are going to stay this high is I think unfounded. And so Opendoor right now, they're in what I call hibernation mode, or they're dormant until 2024, and that's what they said on the call, and that's what I view them as dormant. And they're only opportunistically buying about 1,000 homes a month, and this is understandable given that only 15% of people accept their offers. That's how low the offers are. So they're only buying $1,000 a month, just enough to bring in a little cash and make their cash pile on the stock, and they have close to $2 billion of cash on the stock. Make that last as long as possible, right? And so they're setting themselves up for the long run, such that if this real estate crisis lasts, I don't know, 5 years, they can still survive. But I don't think it's going to last 5 years. And I don't think they do either. And I don't know if you noticed this on the call if you follow Opendoor, but they are still sitting on a tremendous $10.7 billion worth of credit facilities. And if you remember Q4, do you remember Q4? If you listen to Q4, they had said that they would lower their facilities, right? And they would be working. So maybe they're still working on it and they haven't done it. But why haven't they lowered these credit facilities or did their best to try to get rid of them if they are planning to get back to normal and to get back to acquiring again? This is valuable. Access to this much capital is valuable for when the market turns around. And they did not lower that, or at least not meaningfully. And so per my calculation right now, when the market turns around or whenever Opendoor wants to, they could potentially pounce on 38 to 50,000 homes. That's how many homes they can buy with that credit facility. That's absolutely tremendous. That's very disruptive to any local market to have a buyer, a cash buyer, no less, like that. We can just go ahead and pounce and buy homes. And this reminds me a lot, and it's often useful to study companies like in nature. Study a company as if it operates in nature. Very, very interesting to me. And I see Opendoor as a sleeping giant. They're just sitting there. They're just waiting, doing nothing, saving energy. And in their case, it's their cash, saving all of that energy until it is time to act swiftly. I live in the south of the U.S. We have alligators here. I don't know if you know how alligators do it, but they typically will not move, for days. And then a prey comes, and then they just pounce, and they just grab the prey, and nobody sees them coming out of nowhere. This is what this credit facility does to Opendoor. Opendoor is an option on a real estate turnaround. Really, really the way I look at the stock now. Like I said, do you remember Opendoor's peak at its peak? How powerful this company was. These were great times. This company used to be quite powerful. It used to scare the market. They were a $10 billion company. They were very, very strong in certain markets, especially where I'm at in Texas. They were very, very strong in Texas. And there's ways to believe that this is coming again. I fundamentally believe this time is coming again. This is why I named the channel Beat the Denominator. You've heard the Congressional Budget Office. They're short, I think, almost $2 trillion. They're short $1 trillion more than what they thought they would be short, such that the debt ceiling has to be raised now by June and not by September, because tax receipts are down. And obviously tax receipts are down. As an Opendoor shareholder, you would have probably been okay selling here, right? But nobody's selling right now, so there's no capital gains. So of course your tax receipts are down, right? When you fire 500 people, of course your tax receipts are going to be down. And this is leading to some changes in the marketplace in anticipation. So if you look at Bankrupt, which Bankrupt is kind of the best website I've found for current mortgages. If you have the highest credit score and like the good down payment and everything, your 30-year is 5.89% right now. So again, it's high, but it's not nearly as high as it used to be. And remember, there's a psychological threshold at whole digits, right? 7%, 6%, 5%. A lot of people psychologically, when they read 5.89%, they remember 5. So that's also an aspect to keep in mind for real estate. So, but they are steadily going down. If you look, they're steadily going down, and that's not surprising, right? The 10-year is often used as a proxy for mortgage rate, and the 10-year has been steadily down, and it's actually if you do the multi-day average, it's actually trailing down and trading down as well. But even more importantly, so not only did the job reports come and they updated the job reports downward, if you saw, which is the whole reason why the market was up yesterday, is that, oh wait, the economy, the jobs are not as well and not as good as we thought. So maybe the Fed is gonna think about its other coin of the mandate, right? Its other side of a coin, which is full employment. Maybe they're gonna start focusing on that. But when you look at FedWatch, the FedWatch tool, and when you look at the opportunities for interest rates drop, you can see that they've moved up up tremendously. So even though the Fed is telling us no rate cuts, or they're really not telling us much, we don't know. But the market is anticipating the first rate cut in September. Is how you read this chart, right? It's anticipating holding steady in June and July, but in September a rate cut, and then we have a slew of rate cuts that the market is anticipating throughout the end of 2023 and early 2024. So who knows how that's going to change? But as we get those rate cuts, what do we think is going to happen to real estate? What do we think is going to happen to goods that are naturally scarce, like real estate, like single-family homes? I always say in my videos, there's about 83 million single-family homes in the US. You can't build more than 1 million. It's impossible. And in 2022, 2023, there will be less than 1 million homes built. Because, of course, right now in the market, we're not building homes. It's not like you can build homes like you can print money. It's very rare to be able to print more than 1.5% more single-family homes in the US, but the demand is still tremendous, which is why homes go up in value tremendously. And I think this is going to tremendously help a company like Opendoor, who has that credit facility, who can go ahead and pounce and buy on those homes whenever their systems tells them that the market is turning around. And I'll finish with this. Macro is one thing, and it's one reason to own the stock, but any of the stock that I invest in, that I've always invested in, I've had nothing to do with macro, right? My only investment that has like directly something to do with macro is Bitcoin. That's it. Only Bitcoin is like the investment who I chose just because of macro. All of the other ones are because there is an underlying technology. So Opendoor has become a macro play, but it didn't used to be a macro play. Remember when macro was more aligned with the financial situation of the world and not aligned with what people want it to be, i.e. interest rates close to zero. That's the only way you can do it. There's too much debt. You can't have interest rates be this high. The new normal is interest rates close to zero. And assuming we go back to this new normal, which we will, because this is just math, the current situation is impossible. That is why banks are failing. The current situation is impossible. That's not gonna happen. Anyways, I just, no investment advice, of course, but I don't think it is. So macro is one thing, but to me, more importantly, the reason why I was drawn to Opendoor, and I think a lot of investors were drawn to Opendoor, were the innovation, were the challenge that they posed to the status quo of real estate. Real estate hasn't been disrupted in almost 100 years, right? It hasn't been disrupted. There was a disruption in the 50s, where in the 50s buyers started covering the fee for the sellers, such that when you buy a home, it costs nothing, but it's the seller who's ending up paying 6% to sell their house. That was kind of the main change. But otherwise, the cost to sell a home at 6% has been around for a very, very, very long time. And Opendoor, their technology is disrupting that. Because just like we see it in fintech, we don't need a network of banks anymore, right? We don't need a network of realtors anymore. We can just have an app do everything for us, right? You can just have an app and film a home with an app, and you see it with all of these websites. You furnish the house however you want. The app measures the homes, detects things in the home. I mean, that is so obvious to me, and people may disagree. That is so obvious to me. And Opendoor, I think, in 2021, people were seeing clearly the threat. Just like if you were to talk about an electric car to someone who's more into the legacy world and really enjoys gas cars, they'll find every single way to bash that electric car and criticize it. And when I was in 2021, I was actually actively selling and buying a house, and I did both transactions through Opendoor, but I actually also went through traditional realtors, talked to a lot of them, etc. And every single realtor I met bashed Opendoor, but not just Opendoor back then. It was Zillow, it was OfferPad, a lot of other websites. They were actively bashing them. It became almost trendy whenever you talk to anybody about real estate to say, oh, these homes are horrible. Oh, these are the worst homes. They overpay. It became almost trendy. It was almost a thing on social media. It was very trendy to say. Never mind the fact that the home that I sold to Opendoor was a very nice house, and the house that I bought from Opendoor was also a very nice house. And I can guarantee you, a lot of the people who sold their homes to Opendoor, that was their family home, and they probably miss those homes, and they were nice homes. And this whole black or white, all of the homes that Opendoor was buying was horrible. This is not accurate. This is not thoughtful thinking. This is just emotion. If you go back to 2021 and you study again what was going on in 2021, many realtors were leaving the ship of brokers, if I may call it like this, and they started, quote unquote, Ubering for Opendoor. So what Opendoor was doing and is still doing is they had this partnering program where if you're a realtor, but you don't like the whole commissions based sales system, and you like to have a steady income, a lot of realtors were just fine signing up for Opendoor and spending their full day showing homes on their own schedule for $25 an hour. That's what Opendoor was paying, $25 an hour to show home all day long. And a lot of realtors actually loved that and moved to Opendoor for that. They were like, I don't have any pressure. I can have the best interest of the clients in mind. I can just show homes all day for $25 an hour. So some realtors had left the shift. But more importantly, and I'll conclude to this, I think a lot of these headlines really are a testament to the power of iBuying platforms, and Opendoor is obviously the king of iBuying. If you may remember this viral video in 2021, which it was Zillow who came under attack for this, not Opendoor, I just want to say, but there was this video from this realtor right here who was pretty much getting upset at Zillow buying so many homes. And of course, if you're a realtor, right, you're a seller's agent, much of the money you're going to make much of the money in the business has to do with finding the homes for sale, right? It has to do with how many homes are you listing? How many sellers of homes are you representing? That's a big chunk of how you make money in real estate. And of course, if you're a realtor and you see home buyers coming with cash offers, just buy a whole bunch of homes, business is going to dry up. And that was the whole point of this video. And actually, this video I highly recommend watching it. Very interesting video. He in the video, as somebody says, well, of course they buy cash and they pay cash, of course. Well, yes, they pay cash, right? I showed you the facility, $10 billion facility. Yes, they pay cash. They're a liquidity provider. They provide liquidity, they pay cash, and they're extremely powerful. It's a very, very, very powerful combo. It's really taking the mom and pop business of realtor and turning it into a public company. Which, for example, if you follow my channel, I cover Airbnb. That's my same thesis for Airbnb. Airbnb is taking the mom and pop business of renting homes, short-term rentals and renting homes, and actually most homes rented on Airbnb are longer than that. They are taking that business and dealing it as a public company, not as a mom and pop business. And Opendoor and iBuyers at the time were doing the same thing, and I believe this will return to that state, because in a world where technology is prevalent, we have no business paying 6% for every single transaction that we do. And thus, if you also sell a house and buy a house, by the way, it's not 6%, it's 12% that you're paying, right? Because that 6% is built into the price. And of course, that product was so compelling, so much better, but when you look at the data, you can see, and this was just the beginning, by the way. I cannot imagine how strong these home buyers would be had the Fed not gone through its bluff period of raising interest rates, right? Because we know, they're going to take them back down. But had the Fed not done that, I cannot imagine how high this would be, right? This was just Q1 of 2024. You can see, look at the number of markets who were nearing 10% of homes sold to iBuyers. The market was clearly telling us something. Sellers preferred to sell to iBuyers, and buyers prefer to buy from iBuyers. And that was my experience with Opendoor. And I believe this is still the future. You can't fight a better business model. Once a business model is fundamentally better, at some point, it will win. And that's why if you go back to my early videos on Opendoor, I was like, well, you know what? Even if Opendoor fails, there will be a company that succeeds at doing this, and you can bet I'll be investing in that company that succeeds at doing this, because those 6% in fees whenever you sell a house and whenever you buy a house are too high in a world that is technologically flat. And at its core, Opendoor, right now, I realize it's managed by a finance person, it's managed by a financial team. But at its core, Opendoor is a technology company, and I think it will get back to its DNA. And anyways, yesterday was a great day. Love Opendoor. Again, not investment advice whatsoever. I know I'm wrong. You've been telling me in the comments section that I'm often wrong. That's fine. It's not investment advice. It's just entertainment. I appreciate your likes and your subscribe if you like the video. Thank you. Have a great day.